In exercise 4-14, what we're going to do is prepare a classified balance sheet. And this is as at December 31st, 2020. So my first step when preparing the classified balance sheet is to identify my current assets. So the current assets is basically anything that can convert into cash within the first year. Or the current year. So when I look through all of these accounts, the ones that catch my eyes, and I'll just highlight them in yellow, is cash. So cash is always the first one that we list on this statement. Accounts receivable is also a popular one. I don't see that though. So let me just see. I see I see a notes receivable. I'm just going to put a little question beside that because sometimes this could be both current and long-term. And I see merchandising inventory. So those are my current assets. So maybe I'll just do a little legend here. Current assets. Highlight those in yellow. Now, I'm also going to look at my long-term assets. And then these ones are assets that take longer than 1 year to convert to cash. And maybe I'll just highlight those in blue. So again, the only thing that I see on here as a long-term asset is part of this notes receivable. I think could be long-term. I'll have to read more into that in the question. And then my equipment is a long-term asset. My furniture is a long-term asset, as well as my accumulated depreciation equipment and accumulated depreciation furniture. So those are my long-term assets. Now I'm going to now think of all of this in terms of current liabilities. So current liabilities are any debt that you have to pay within 12 months. Okay, so when we think of those types of debts, we're thinking accounts payable, we're thinking wages payable. So basically anything that says payable after it could be a current debt. Now I'm not too sure actually about this bank loan. So I could have the same problem with the bank loan, is that I could have a current portion and a long-term portion on that. So that leads me to my long-term liabilities. So those are any liabilities that take longer than 1 year for you to have to pay them back, you being the company. So again, when I'm just looking through here, I'm thinking maybe that bank loan might have a current portion to it. So I think that's probably enough for me right now to classify or start classifying the balance sheet. And then I'll come back here when I get to shareholders' equity, but I'm just going to start off with my current assets. Okay, so here's my template. So Sunshine Sushi is the name of the company. The balance sheet is the name of the financial statement. And because the year end is December 31st, all you need to say is December 31st. Now we start with assets and then we list our current assets in order of liquidity. So my first current asset was my cash for $115. So I'm going to put that here. Cash, $115. And now what I'll do is I'll just strike out cash because once we use it, we don't use it again. Now my next one in order of liquidity is your inventory. So usually it goes cash, accounts receivable, inventory. So I'm going to put the merchandise inventory. And next, and it's $34,250. And again, I'm going to go back to my balance sheet and just cross that off. because once you find a home for it, it doesn't go anywhere else. And then my notes receivable, remember I said I didn't know which part was current and which one would be long-term? So if you read right up here, it says for notes receivable, $41,500 will be collected in 2021. So that means that's the current portion. So if I just write down here, notes receivable, my current portion is the $41,500 because they told me. And then I know my total is the 115. So that means my long-term portion is the difference. So if I just take 115,500 minus 41,500, that would give me 74,000. So it's going to be this amount that I bring over, the 41,500. So if I see notes receivable, current portion, and that's 41,500. Now what we need to do is total all of our current assets. So add the 115,000 plus 34250 plus 41500, and that gives me 190,750. Now the total non-current investments, so we're not talking about the equipment or anything like that, that's the long-term notes receivable. So let me just find that here. So notes receivable non-current, and I'll just go back here. And we said it was going to be 74,000. So I'll put that in, and then I can cross the 115,500 off. So 74,000. So I have my current assets, I have my current non-current investments, and now I have my property, plant, and equipment. So again, I'll start with my equipment of $373,875. $373,875, and now we subtract the accumulated depreciation for the equipment, so that's just a contra asset account, and that's this one right here, the $99,700. And if you take the $373,875 minus the $99,700, that gives me a net book value, that's what we call it when we have those two totals together, of $274,175. Now we're going to do this again for the next piece of property, plant, and equipment. So this one was furniture. So here's the furniture, 102,000. So we'll find the furniture. And now we're going to subtract. So you always subtract the accumulated depreciation. And in this question, it's 38,250. So 102,000 minus 38,250, that gives me 63,750. And I need to put that right over here. Let's see. 38250. And now right here, I want this to be 63,750. So that's the net book value of that. And now in this little square, we're going to add these two together. So add both the net book values together. So 274,175 and 63750, and that gives us 337,925. So now this is actually subtotaling all my assets up for me, which is great. If they didn't, then what this subtotal is my 74,000 and my 190,750 and my 337,925. Now we're going to move to our liabilities. So with our current liabilities, what I see here, so remember I highlighted them in orange, so in order of liquidity, I'm going to do the accounts payable first, because usually we put accounts payable first, then the wages payable, and then part of this bank loan. So again, if I just write bank loan down here, I know the total is 501. So I need to know what part of this is due within the next 12 months and then what part is due a year, like further than a year from now. So then I'll just say current and long term. So maybe right up here it says the bank loan of 6,550 is due in 2021. So that means that part is due next year. So now I have the current amount, which is the 60550. And if I subtract that from the total loan of 501, that means my non-current amount, so this is the rest is due after 1 year, of 440450. Perfect. So now I have all the information I need to do my current liabilities. So we'll start with accounts payable. Put that in for 41,625. Then I have my wages payable, and put that one in for 30250. And then I have my bank loan current portion, and we said that was 60550. So let me go ahead and check them all off. So I've got my 60550. I did my accounts payable, and I also did my wages payable. So once you use an account, you can't use it again. And I'm going to add up my total current liabilities. So if you add the 41,625 plus 30250 plus 60550, that will give me total current liabilities of 132,425. And now my only non-current liability was the long-term bank loan. So I'm going to move that 440450, and then I can cross this bank loan off. So bank loan non-current for 440450. Then I can add up my current liabilities and my non-current liabilities. So those are my long-term liabilities, and those equal 572,875. So now what I need to do is put in my capital account, so my equity account. So I'll show you two ways to do it. I'll use a really quick way. So what you can do is put in your equity account. Let's see here. So Natsuki Capital. And since I know that my total assets are 602,675, I can actually subtract my assets from my liabilities, and that will give me my capital. So that would give me 29,800. And I know that's correct because when I do the accounting equation, it's always your liabilities and your capital equals your assets. Okay, here's the not so quick way. So I'm just going to do a statement of investment income. Or maybe even quicker, I'm just going to identify the accounts that I'm going to take. So if I have my opening capital, which is this 28,500, and I subtract my withdrawals, of 11,300, And now I'm going to take my revenue and my expenses, so basically my net income. So in this case, it's the 50,750, subtract my expenses. The only other expense I see here is the 38,150. So that's 12,600. And now if I add my capital, 28,500 minus my withdrawals of 11,300 plus my net income of 12,600, that gives me the 29,800. So that's my ending capital, which also is that amount that I just plugged. So if I just go, that's the 29,800. And now that I'm in balance, I know I did a pretty good classified balance sheet.